Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, an old high school classmate of mine, Peter Christodoulo, shares his winding path and how he ended up as a partner at a private equity megafund, Francisco Partners in SF. We hear about what happened to the tech startup he launched during undergrad at Harvard, his analyst days in investment banking at Credit Suisse, his jump to private equity at TH Lee, and finally, his lateral move to the small London office at Francisco Partners during the Great Financial Crisis. Listen to hear his views on where the private equity market is headed, the trend toward hiring from non-traditional channels, as well as the difference across the PE market in London compared to SF. Stay to the end to hear his advice on how to help differentiate yourself in a competitive recruiting process. Enjoy. Peter, thanks for joining the Wall Street Oasis podcast.
Thanks for having me, Pat. It's good to see you.
Good to see you too.
I'm excited about this.
Yeah, so just for the listeners to know, we went to high school together a long time ago. So Peter's going to give you a quick summary of his bio, and then we'll dive in.
Yeah, so I'm Peter Christodoulo. I'm a partner at Francisco Partners. I've been with FP for now 12 years. I spent the first 5 years at FP in our London office, and now I've been in San Francisco for 7 years. Prior to that, I was at TH Lee in Boston for a couple of years, and before that, I was at Credit Suisse in New York doing tech investment banking. And before that, I was doing some startup-y stuff for a couple of years.
Great. So let's go all the way back to undergrad. So were you like always thinking startup? Like you did a startup right out of school, but was it more like, did you always have a finance bent when you were studying, like you're hearing about Wall Street and everything?
I mean, a little bit, but I would say I was more interested in technology innovation than I was in finance. But since I didn't have a technical degree, since I wasn't like a math major or a physics major or something, or computer science, I have a history degree. So it was kind of like, well, what can you do? And it's like, so the finance side of things seemed to make more sense. And I worked at Harvard Student Agencies, HSA, as an undergraduate doing like refrigerator deliveries and things like that, rentals and whatnot, which I think was more sort of finance and accounting kind of training than anything else.
And so when you were, with a history degree and you were approaching graduation, you didn't do the typical like investment banking internships or anything like that, or was it what happened there?
I tried. I didn't. It was
super competitive.
It was competitive, and also I think I had the week they were doing like internship interviews. Like I had planned a trip with my then girlfriend, and so I was just like, I'm gonna go
priorities,
to Paris.
Priorities.
So yeah, it wasn't quite as good a choice in retrospect, but but at the time it seemed reasonable. So
that's fair. So you kind of missed the boat there on some of the internships, and then so as you're approaching your senior year, you're coming in. You don't have a job lined up, but you're thinking to yourself,
I don't have a job lined up, and I'd taken a year off to work in a startup, and then come back. And I actually I got a couple investment banking offers.
What year? Sorry, what year was that?
That was 2003.
So you took a year off, and what did you tell me a little bit about that? What startup and what was the deal?
It was a tech startup. It was the spring of 2000. The world was at its peak. It seemed like anything was possible. And
everyone was getting funding. Money was just flying everywhere.
Yeah, and so a few buddies from college and a few other folks we knew. We started a software startup, and we raised $600,000 and thought we were kind of on top of the world. And then everything crashed like really, really fast. And all of a sudden, it wasn't cool to like finance kids in college like with ideas. And so we all went back to school basically after taking a year off. So it was super annoying.
Did Harvard kind of take you back with open arms, or what's the process?
Yeah, it was just like you just sort of say I'm taking a leave of. I mean, like 10% of the kids at Harvard, not 10%, but a substantial percentage of people were doing that. And
right.
And meanwhile, like Goldman Sachs couldn't get anyone to like go to their whatever information night or whatever.
Do you feel like there's some parallels to that now, or what, maybe before the COVID?
Maybe a little bit. I think finance has become a little bit cooler or more interesting because it's blending with other things more actively than I think it was. I think there was definitely like a finance track, and then there was like a tech track before, and there is still some of that. But I think that there's more, just like in a lot of things, there's more convergence. Even just like talking, like hearing Goldman Sachs talk about themselves hiring software developers tells you something about like how some of these organizations have changed. So
yeah, Python's in high demand now. And VC is really hot still. So, okay. So let's go back to, so you took that year off, you raised 600K, you did a software startup, and I assume you were just like in the product development phase when everything fell apart. And then.
Yeah, exactly. Yeah. We had like a beta tested product that actually worked pretty well, but like, yeah.
Do you mind sharing what it was? Like, what was the idea?
Yeah. It was the concept was this, that if you're in a large organization, specifically a professional services style firm, a lot of information is caught in your email. And so what it was a search engine that connected to the email server at whatever the company was, and allowed people to do blind searches for knowledge workers effectively. So you could type into our search engine like, let's say you were at a consulting firm, like, hey, we're doing a project for Topps baseball cards. I'm just making up something totally random.
Yeah.
You could figure out if anyone in the company had like, ever mentioned Topps baseball cards in their email, basically. And what it would return is, it wouldn't return a list of names, but it would return a list of profiles. And then you could blind email people and be like, hey, like, we're starting a project for this, cool. On this topic. Like, do you know anything about that? Or would you like to join, would you like to,
almost like internal intranet search type capability.
Yeah, and there was a sort of, exactly, and so
I'm sure it exists now, right? Or something,
or in different ways, right?
Yeah.
Like people, all that stuff's cataloged a lot better today. Between, especially with things like Facebook and LinkedIn, it's easier to figure out like what people are interested in or what people know or et cetera. So, and so it actually worked great. And Monitor Consulting was actually our big backer, and so it worked fine until. It was going great until things fell apart and no one wanted to fund us anymore. No more money and no revenue and things like little stuff like that. So,
yeah. So you go back senior year and along with your co-founders, and you said you had some offers at that point for investment banking?
I did, and I really thought hard about it. A couple investment banking offers, and I really like crushed myself thinking about it. I was like, look, I really want to kind of do the startup-y stuff some more. Mm-hmm. And so then I basically spent another year trying to make that same startup work in a different context. We had some new managers come in and we took it over. They moved the company to California from Massachusetts. Mm-hmm. And so I kind of worked with them for a year. And after about 6 or 9 months, I was just like, this is not working. And so, and then I was like, shoot, I should have taken one of those investment banking jobs that I had.
Oh, so you had kind of turned it down?
Initially. I turned them down. Yeah, I turned them down. And then I was kind of like on the street basically. And so, but I did know some people, and I had, he'd gone through those interviews and whatnot. And so through some friends of friends and pounding the pavement, I was able to get hired at Credit Suisse in the summer of 2004. Kind of off the street a little bit, outside of the banking class. I pitched them hard that I knew a little bit about technology, a little bit about finance, and I wanted to work in their tech group, and they hired me. So
I hired you as like a first year analyst, off cycle.
Hired me as a first year analyst, 2 years old for my grade, off cycle. Exactly. Just like the pro, very off spec basically. But
do you feel like those extra 2 years of like made you a little more like a senior analyst, or not like you felt more mature maybe compared to some of the other?
Well, I did a little bit, but the funny thing is I missed training. So all the other analysts had like 8 weeks of training or something over the summer, and they gave me like 3 days of training, and then
you're from a liberal arts background with no
and they're like weighted average cost of capital. I'm like, I don't know what the hell that is. Like what's this equation? And
oh my gosh,
it was crazy. But basically, I'd say there's the big difference though, and this is I think important, is because I had sort of swung the bat and missed on the startup stuff, and because I was so darn thankful to have a job in investment banking, off cycle, old for the grade, whatever. I worked really, really hard,
Mhm.
and I didn't treat it as sort of an extension of college the way that some people, I observed doing, right, saying like, "Hey, it's Tuesday night, like we're out of work at 10 p.m. Let's go boozing or something." Like I didn't do it. I didn't even come close to doing that stuff. I was probably at the office to midnight more than half the days of my 2 years as an analyst there.
Right.
Um, and just work really, really hard, try not to like, stir up trouble or whatever. And it was more of like a no fail situation for me,
Mhm.
than I think some of the other folks. And so because of that, I got a lot out of it. I mean, I also like crushed myself, but I think my mindset was a little bit different. It wasn't like, oh, this is a job. I was like, this is like the job. And so that was unique, I think.
Back then, 04 to 06, there was, the on cycle recruiting process was much later. Was
Yeah.
that always on your radar, or did you even know like what private equity was and had it in your head, or what?
So I knew a little bit because we sold a company to TA Associates,
Mhm.
and so I worked on the sell side on that, and then I worked on an IPO as well, which was a GTCR company. So I kind of had a little bit of sense of private equity funds, but the whole recruiting thing, I just missed the boat completely.
Yeah.
And it was like already half over before I'd even like thought that I should be thinking about it.
I mean, back
Um,
then it was probably done in your second year though, right?
it was done
End of your first year or something?
it was done like the summer, yeah, so like about
Months.
13 months in. So it was like July, August is when it started.
Now it's a full year ahead of that.
And now it's a full year ahead of that, basically. Yeah,
Yeah.
but so I got my job in September, and that was considered quite late. And
Mhm.
and actually, the was interesting was the firm I went to, TH Lee. They were caught a little bit late too, and that's why the KKR and Blackstone and all these places had already recruited.
Yeah.
And they were and I think and so they were. It was when this like rat race kind of like oh, we're going to go earlier, we're going to earlier, like that sort of dynamic was just beginning.
Yeah. The
um
game theory started
the game.
playing out.
Right, right. Now we're already at the point where maybe it's gonna come back on itself, but we'll see.
Yeah, we can talk about that in a little bit. I think so. You were a little bit late, but some of the other firms were late, so you still got into some processes. Was it the typical head? You spoke to some headhunters, they had you come in, and were you like dead set? After killing yourself in bank for a couple of years, were you like, hey, was there any thought process of, hey, I want to stay long term, sell side?
um a little bit, but the thing is, the banks also, like I was at Credit Suisse, they missed the boat too. they,
Mhm.
they made me a third year analyst offer 6 months after I had already accepted a private equity offer to be an associate.
They were
And
late.
I was like, God, and they offered me like a $5,000 bonus to like stay as a third year analyst. And I was like, guys, I've already, like, you should know that I've told people that I accepted this job like 6 months ago, and it's an associate title, and you're giving me a third year analyst offer like now, like in like like this like weird mailing thing I got. No one even told me in person. And I was just like, we're like not close here. And then I think now,
Yeah,
since they and other banks have gotten a lot,
they've got a lot more
a
aggressive.
lot more strategic about that. But yeah, it was like early days, cowboy, Wild West days of how this used to work. And so yeah, I got a letter saying that I'd been selected for a third year.
Congratulations,
I was
we
like,
have bestowed
yes,
upon you. Like,
yeah, I can stay another year crushing myself for you guys.
yeah.
And but I think to your question about, like, so I did go to some headhunters. I was extremely green though, and I'd say my first couple interviews were just disastrous.
Hmm.
And I knew they were disastrous when they were happening, but I didn't even know how to prepare for them. They're asking me questions like walking to one of the, a few of these, I had like modeling tests, like build an LBO model. Like I had never built one.
Yeah.
I'd worked on an IPO and I worked on a sell side, but um, no one had ever explained to me how to. I'd never had an opportunity to do that in the first year. I was like just getting some of that
Yeah.
in my second year. But I was like, build an LBO, and I like don't know how to do that. Like how do you define free cash flow? I'm like, I don't know. Like I look on the cash flow statement, and it's like cash flow from operations, like. And so yeah, I just like totally bombed like a couple of like one of the interviews, I won't name where it was, but one of these interviews I went to, and they asked me some of these questions, and I was so bad that they like I met like one person, and then I had one like 30-minute interview, and then I left, and everyone else had like multiple interviews. They clearly had like
just X'd you out.
Like X'd me early.
That's great.
And the funny thing though is that like I don't know, maybe because I wasn't as close with some of the other analysts, and I wasn't like in the flow on kind of like the chatter. I was just like working on the job. I was like focused on my job because I was so like thankful to have the job, and I was so ingrained in that I just sort of missed the whole whisper culture around how to prepare for this. Like what
there's like
questions they're going to ask
documents
you.
to go around.
Yeah, all these like kids are like sharing these things.
LBO
And, like,
modeling tests. Yeah.
And I was just like, I literally had not seen one of those before I went to some of these.
And the WSO private equity course, I don't think was out yet. So you had nothing to go on, man.
Literally not. I was like literally like just answering the questions as like, some educated guesses. So that was kind of funny. And then I smartened up a little bit. So I after a couple of those, I was like, hold on, time out. Like I need to. So I started asking around. They're like, oh, that's how you answer that question. That's how you answer that question. I was like, oh, okay, this isn't, I just need to like get my shtick down. And then all of a sudden I got like 3 offers on my next, each of my next 3 interviews were good and went into a good place. So yeah.
And so most of those I assume came through recruiters and whatnot.
Yeah, absolutely. But the whole like, it boggled my mind, just like the whole how like ramshackle and not organized and you're getting tested against these like little cheat sheets are like going around among the analysts, and it was just like ridiculous. Like the whole thing was ridiculous, but that's what it was.
Yeah, it's funny because I think I was even later than you.
Oh, really?
I didn't end up at a THA. I ended up at a small shop in Boston. I ended up getting fired pretty soon after. But because the fund was going like this, I didn't know that at the time, but I was super late. And the only reason I got a job in private equity was probably because, I had my head down like you, 90 hours. I was clueless. Some kid was like, oh yeah, you want to go to private equity. Here's something from Morgan's. Here's a deck from like Morgan saying, what is private equity leverage and how you generate returns. And I'm like, that's pretty cool. Like that's genius. And so I started studying that, and that was the only reason. Then understanding how to like talk about your deals and frame them properly as an investor would, I think was really important. But yeah, if you don't know what to expect, you're just done.
Totally.
To the point where SEO, the program SEO.
Yeah,
helps kids. They're using our mentor program to prep the kids that got offers that are starting in banking because they know the private equity interviews are happening so fast.
Right. And now as a private equity person who interviews some of these people, like the rudimentariness of the questions we now ask, because the people have been on the job for like, it's like they got out of training like 2 weeks ago, and they haven't like, they've done like one comp set, and like that's like all they like.
They'd like to put together some PIDs or something.
Right. And you're like you don't like, there's like nothing to quiz you on. Like I don't even like do you like skiing or something? Like
yeah. I guess that's a good question, is what, given the accelerated recruiting, have you guys tried to like test for any sort of like raw intellectual horsepower or anything like that? Or is it more like how personable and how much drive and grit they have, anything like that?
We've had to rethink how we do some of that stuff. And I think we've done a couple things. One is we still do. I would call it we do some modeling testing stuff, but it's more something that you could do intuitively than it is about like rote memorizing how to like define free cash flow as one example. Like, and so it's more about like reading about so we do this little thing where you read about a company, and then you have to like answer some questions, and some of them are qualitative, not quantitative, and some of them are quantitative, or how would you think about this, or what diligence questions would you ask like this company, like stuff like that. So it's more about like trying to tease out like what kind of thinker they are and that kind of stuff. And there is some modeling associated with it, but it's not like
crazy complex.
And I'd say when I first joined FP, it was a little more like crazy complex, because they were testing people. They want people to come in and kind of know how to do everything. So that's one thing we've done. We've modified kind of, our recruiting that way. The other thing we've done is we've started bringing in some non-traditional candidates from different walks of life. So maybe some people who went to law school, or some people who, worked in a company or did some other things, and
a little more
or worked in politics or something and decided they didn't. Sorry.
What about like management consultants? Have you guys looked in that pool?
Yep, we actually have always had a history of some management consultants. So I think I'd say historically our analyst classes of, call it 5 analysts or associates, our associate classes of say 5 associates, you might have like 3 or 4 bankers and 1 or 2 consultants.
Okay,
that was kind of like the historical kind of way we've done it. And now I'd say there is still that sort of general mix, but then we've now started to add a couple other kind of candidates, and we've expanded that a couple more people, because we also, I think, because we're interviewing people earlier in their own careers, and because it becomes harder to, I'd say and this is going to come out slightly wrong, but just bear with me. It's like, I'd say the hit rate of successful associates is also maybe a little bit worse than it used to be.
Yeah.
Because because they're a little bit further away from knowing what they want to do. They're a little further away about knowing about private equity and knowing how we operate, and whether they even like finance. Like, they've been working in finance for like 2 weeks or 6 weeks or 8 weeks or whatever.
Yeah.
And they're being asked to make a decision about what they want to do 2 years out for another 2 years or 3 years.
Right.
And so, like, I'd say like there's
things change.
Yeah. And so, like, I'd say our hit rate of people who like the job, want to do the job, do a good job, is probably 20% lower than it was 10 years ago.
Yeah. That's tough.
It's a bit of it's tricky, but we found sometimes the non-traditional candidates are actually also a little bit like me at Credit Suisse, like thankful for the job, like know it's kind of unique opportunity, and it is, right? So
for sure it is. I know at least on WSO, PE is held in extremely high regard. So talk to me a little bit about going back to your story. So you're able to make that transition. You button up, you get your prep right, you get into TH Lee. You're there for a couple of years, and your transition, your timing's interesting. You're leaving. Is it kind of a 2 and out program where they're like, go to get your MBA, then come back? Or
so that's what TH Lee is. Yeah, so I joined there in July of 2006, and then I ended in July of 2008. And it actually, I remember distinctly, my offer letter from TH Lee had my like start date and my end date, basically. Like, it wasn't, it's two and out and like hard and fast kind of thing. And that was just, they made that very clear. And pretty much everyone, not quite everyone, but pretty much everyone who had gone through that program would go to business school afterwards. I'm
curious why you didn't do that path, because it's such a well-worn path.
Yeah, well, there's a few things. One, the first one was that because I was 2 years older for my kind of grade. I was a 26-year-old first-year associate there, and I was 24. I just turned 24, or I was turning 24 when I went into banking. Yeah, so like I was a little old already, and I was like being reminded. This is my own personal sort of psychology on this. The idea of like going to business school and quote wasting like 2 more years just felt so, uncomfortable for me. And also in between 06, 07, like the path of like becoming an associate and like staying through, or being a lateral to someplace else, what felt more reachable, because just like in the boom we've had the last few years until recently, there's been a lot more opportunity as there's more jobs and more money flowing into private equity. And so while TH Lee was telling me I had to leave, the idea of going laterally to another private equity fund felt very kind of achievable.
Even in 2008?
Well, when I made the decision, it was different than when I left.
So tell me about when you made the decision, or like how that. So you knew you were getting out. You were thinking. Were you ever thinking about business school? Did you ever like take the?
I was. Yeah, I was thinking about it, and I would say that I was thinking about it for sure, and I had one of these moments where I was just like, I'm not going to be that thrilled with it.
Right.
So But the other thing that was difficult is when I was at THLE, and I was starting to interview at some other places, all of them were like, well, when can you come to New York? When can you come to London? When can you come to San Francisco? Because most of the Boston firms are very much like go to business school kind of places. And so the Boston firms were, I'd say, much, they just weren't as willing or interested in breaking those kind of rules, like saying, oh, we'll bring you on laterally. And so I was having to go to other places. And then my answer was, well, I'm an associate in a private equity fund. I don't just like get on planes and like I'm working here like on a team and stuff. I can't just like fly to London for 2 days of interviews. I can't go to New York like on a whim. And I did a little bit of that. Like I asked for like a Friday off here or this or that, and I was able to do it a little bit, but it was very hard to actually land a job until I was out of THLE. Because
it reminded me of my bank. We're trying to recruit for private equity in your banking. It's brutal.
It's brutal, totally.
Yeah, it's really hard, like because you're working long hours. I mean, maybe I don't know what the hours were like at THLE. I assume they were pretty tough. Maybe not banking hours, but up there. And then, like you said, the Boston firms maybe were a little more traditional, and the MBA hire that they didn't want to give you a post MBA seat without the MBA, right?
For sure. Or even if I were willing to be like a senior associate or something, or a third year associate, like they just they didn't have that in the same way. So the places that and actually one Boston firm did eventually give me an offer. It was a newer firm that was a smaller firm, but they wanted someone who kind of knew how to do a lot of stuff because I was going to be the only associate there.
Yeah.
And so I chose not to do that, and I chose not to go to this firm in New York. Instead, I went to Francisco in London, which actually was a total. The whole thing was a bit of an adventure, moving from Boston to London. I just got engaged, so my fiance and I moved over there, moving firms, and then doing that in the summer of 2008. I think I signed in July 2008. And then we showed up in London like the first week in October. And like, it was like a ghost town, like Bear and Lehman had gone under, and like oil had crashed and all the oil money had left London. And so there's like,
were you worried about your job? Did you feel like,
yeah, I was like, I just moved to another country.
Yeah. I hope.
I just moved to another country. I'm, newly engaged. And
the world is melting.
And the world's melting. It's like, okay. But no, we persevered, and it was actually a really great experience. And what's interesting is Francisco I guess I'd say at the time, Thomas Lee was a very like finance oriented place, and still is. But at that time, I'd say like they were really their finance, like the modeling and all that was like really involved. And I wasn't very good at it when I first got there because of my banking experience wasn't as robust on that. But coming out of that, I felt really, really, I felt like from a technical skill perspective, that was great. But then going to Francisco, it was, these tech companies sometimes they're not as difficult to model. I think they become more complicated as the IT, as the information technology world has gotten bigger and bigger and more complicated and whatnot. These companies have become more complicated to do things with. But I'd say at the time, it was great because I felt like I had kind of checked the box on the modeling in a way that maybe I wouldn't have had as much at maybe a middle market or smaller market fund or sector specific fund, where it was more about the sector. And so I think going to FP at that time was kind of interesting because I had a little tech experience, and then I had gotten some really solid technical skill experience. Yeah, exactly.
So you kind of felt confident. You were confident because you'd already done the job for 2 years, even though you were in London. It's a little bit different. Tell me about those 5 years, like how things progressed. What was it like? Was it a big office, big team? And then what had you come back here?
Yeah, it was quite fortuitous, the whole thing. I mean, and Francisco was great with it in that when I joined there were 4 of us in the office. We actually went down to 3 people in the office for a moment in time in early 2009. And then, but when I left in early 2013, I think we had 7 going to 9 people there. And so we kind of, these are investment professionals I'm quoting.
Yep.
But going there to an office with, 3-4 people at first, the autonomy, the sense of team, the opportunity set was pretty interesting. because there's no staffing and there's no.
Was there a set, like how integrated were you guys from like the London office to the SF? And were there certain like set?
Somewhat integrated, but
But
and
like,
we'd
is
often
there
have.
set assets under management for each team? Like, are you guys responsible for each, or is it all one big pool that you guys are just pulling from?
It's all one big pool.
Yeah.
The sector expertise stuff was was all in San Francisco.
Okay.
And we were kind of regional coverage in London, and that's still broadly how we do it. But there's a little more sector expertise in London now. But what that meant was they were all, like, I'd say at the time, and even still today to some extent, there isn't as much tech in Europe as there is in the United States. But the opportunity to be a bit entrepreneurial and like call on these small tech companies and go to different countries and break through cultural barriers and things like that was a lot more obvious, I think, than in San Francisco, where the associates there were getting, we get hit with 20 opportunities a week from bankers or something. And it's not an issue about, it's not like, certainly we're doing outbound sourcing, we're doing all sorts of things like that. I'm not trying to say not, but I'd say in London, there was more opportunity for me to sort of, do, kind of try to make my own mark and trying to be proactive.
A little more entrepreneurial,
a little more
lower market, like smaller businesses slightly, or
smaller businesses, smaller team.
Yeah.
More kind of ability to, more confidence, not as much. I'm not saying, again, not to say it's bad at a larger place, but, less being viewed as a unit of capacity,
right,
and more, more integrated kind of team member.
So did you feel like, you're joining kind of whatever the title they gave you, associate, senior associate, whatever,
I was an associate. I was an associate for 4 years.
But you were basically, you're one of 3 people in the office. So you were doing a lot of the source. You were doing a lot of both the modeling, the analysis, everything, but you're also out there meeting people and trying to.
Absolutely.
And so that was a big part of your job, you'd say. What do you say in terms of like right off the bat? Was it like that, or did they expect that from you, or were this more senior guys there doing it?
No, they didn't expect that from me right off the bat. Nor was it really expected really at any time. But I'd say I'd say the market there is just less organized because there's all these different countries in a pretty small place. When Morgan Stanley doesn't just like get hired on every software deal or something, or whatever. It's like you've got cultural things, you've got regional companies, you've got companies. Some companies they would, as a representing a California tech fund in London, we'd fly to Italy or we'd fly to France or take a train to France or whatever, or do go to these places. And some companies were like, we really want we want a little Silicon Valley pixie dust. And they like reacted really positively to the idea of us becoming an investor. And other places, you'd go or other, not even places, just situations. Mm-hmm. You'd go and you'd be like, you'd have this sneaking feeling that like a local fund was going to do the deal because like so-and-so was roommate or brother or cousin of someone else. And it was like the whole thing was an inside job and you were just never going to, had never really had a chance. And so being able to sort of suss out those kind of situations and figure out how we can do things was part of my job. The other thing that was really interesting to have in the European market that was a little different than the U.S. market is there were tons of companies that went public at small scale. So 4, 05, 06, 07, it was like very hot. It was a very hot thing in Europe to go public as a means for companies to raise money, because it was just easy, because it was just easier than trying to find a venture or private equity investor. So you'd see these companies go public with 10 million euros or pounds of revenue, or 20 million or 50 million or whatever, and they were just small companies. And then when the recession hit, a lot of these companies they were still public, but their stock didn't trade because it's like a 70 million euro market cap company, and like no one cares. There's no research. There's like one trade in the stock a week or something, and it's on the secondary exchange somewhere. And these companies had like all the costs of being public and none of the benefits. And so one of the things we did was we went and took 7 companies private over a course of a few years there. got very good at that kind of at doing
Well,
some of that.
the timing was really interesting, right? Because if you were putting a lot of money to work from 2009 to 2012, you're pretty happy.
Well, that's right. That's
Yeah.
that's right. But also, we'd see these companies. It's like, wait a second, you're a 30% growth software company, and you're being valued on like LTM, like EPS or something,
Yeah.
and and we look at these companies, like some of these we pay, and obviously the market's become much more efficient now. I'm not saying, but
Right.
at the time this was the air pocket,
Yeah.
and we paid like 70, 80, 90, 100% premiums for companies, all equity. Like, just, we'll write a check
You just
at a
bought.
70% premium, like to buy the whole company.
Yeah.
And as a class, those deals did very well for us.
Yeah.
Which tells you how inefficient it was at the time.
It's so interesting. Yeah, I'm surprised, that even these I guess some of these micro cap names, there's just been no coverage. There's not enough retail people chasing them to buoy it. Right.
Well, that was true. And the other thing that was true is that tech wasn't sexy in Europe at all at the time.
Interesting. Okay.
It just wasn't
really, that surprises me because, I guess this was 2009. I guess we just gone through a crash and everything. Maybe people were more, I guess.
Yeah, like stuff like real estate, oil, financial services, were much more kind of where a lot of the economy was and is. The other thing is, I'd say, Francisco, the idea of going to a tech sector specialist fund wasn't really a thing there. We had a real hard time for a few years recruiting good talent in Europe, and that's part of why they sent me there. That's part of why we sent a bunch of other Americans over there, because we couldn't recruit the best people in Europe when we started there, because no one knew who we were.
Yeah.
And going to a smaller middle market sector specialist fund that did tech was like not a cool thing to do.
I'm surprised with, like, you guys had some good AUM by that point, right?
But we did, yeah. But
like, couldn't you just be like, hey, we have, whatever it was, $1 billion or whatever. I don't know.
Well, we started as we did more deals and more people took notice, we were able to kind of recruit better, and now I think we're in a good place. But it was definitely an interesting process to see that happen. We didn't really have, I think the right word might be, pedigree. And
especially in Europe. Yeah.
In Europe, that felt like a bigger deal maybe. So.
Yeah, the history and the pedigree. Got it. Makes sense. So you were there for a good 5 years, a solid run to be away from. How often did you come back, see family, and
well, I think the first year we were there, we were invited to 17 weddings in the United States.
Oh my God!
Because it was like kind of that time of life where maybe not 17 but 13 or something crazy. So and so we tried to go to a lot of them. We couldn't go to many of them. I'd say I would probably go up in the U.S. 3 times a year for work, 4 times a year for work, and then I'd probably come another
couple times.
I don't know, five times a year for personal stuff. But it would be all these like crazy weekend trips to go someplace. And then the other thing is, no one really cared, but like we'd be taking Sunday night red eyes back to like go, and then like landing at Heathrow and like going to the office like directly.
Yeah. Brutal.
And you feel like you get hit by a train for 3 days. So it was tricky for a while there, but look, when embracing it and kind of saying to the family, and friends and others, like, say, hey, come to London, come, we were young, and we actually had our first child over there, and the whole experience, like, that was the experience, and like, so we tried to immerse ourselves as much as we could in it while we were there. We kind of knew in our hearts that it wasn't going to be permanent. So
did you have were you able to establish like a good set of friends there through the company?
For sure. Yeah.
Mm-hmm. How did you do that? Because like I feel like you're kind of young and it's a small office. Was just through like friends of friends that knew people who lived in London, or how did it?
Well, it's funny. I mean, I'd say a fair number of people from college and even high school, and then people that you just sort of meet a lot. The expat community is also pretty tight there. So
yeah,
the Australian expats all kind of hang out together, and the American expats and the French expats, and there's some intermingling. I'm not saying like, but you kind of get to know a bunch of people, and being from Boston, there's a pretty big sort of Boston contingent there. just given, I think, there's some cultural similarities and things. So,
yeah, I did a podcast earlier. The guy was a Jets fan. He was not liking my hat very much. I have a Patriots hat on for those who
oh, really? Okay. Yeah. Well, yeah. So we definitely had some, like, the Patriots are playing, or the Red Sox, or
yeah.
I remember actually the Celtics were playing the Lakers in the finals.
Yes.
And like, I'm, going to like a watch party at like midnight to, because the game started at, 1 a.m. London or something.
Oh my gosh, brutal. Yeah. That's fun.
So anyway,
that was good. But, so you're there. What kind of, eventually did you start kind of asking, hey, is there a spot in SF, or was it they wanted you back? How did you maneuver that? Because
it'd be
tricky.
It was a little complicated. Yeah, no, to ask you, it was a little complicated. There were a lot of competing different interests there. One, we didn't really hate London. We liked it, so we weren't like in a rush to leave.
Mm-hmm.
The other, though, was that, I think my boss, the head of our fund, said it well to me. He sort of said, "Hey, Peter, look, you can stay there if you want. I think you might be a little bit career limited there, because you had a couple people kind of more senior to me and he's like, I'm not sure how many partners, that office can kind of have long term. So you may be a little bit pinched if you stay there, but you can stay there."
Mm-hmm.
But he's like, but don't tell me in 3 or 4 years you want to come back, because he's like, either come back and make your career here. You have some European experience. You have, so that's good. You got global experience, some East Coast experience. Okay, blah blah blah.
Mm-hmm.
He's like, but if you stay there, like, and I was like a second or third year VP or whatever at the time.
Yeah.
And he was just like, look, just decide. Are you gonna have your career over there? Or are you gonna have your career over here? And let's make a decision one way or the other, kind of now-ish. Because if but if you come to me in 2 or 3 years and say, hey, now I want to come back, then you're in this like weird spot where, like,
you've already been there for so long.
You're there so long, all your contacts, your professional career, your deals, your expertise is more there versus coming back and sort of building all that up here, leveraging some of what you have in Europe. It's not irrelevant.
Yeah.
But it's it's more just like, where do you want to kind of make your bed? And I thought that was good advice, and so we decided to come back.
And so, was there any thought of going East Coast at all? I mean, does FP have any options?
We now have a little office in New York for our credit fund,
right.
but at the time it was San Francisco or nothing, and even still now it'd be San Francisco or nothing for equity fund people.
Got it.
And so so it was San Francisco. So we never lived in San Francisco. So we from the East Coast, went to school and worked there, and then London for 5 years, and now West Coast. It sort of felt like that's okay. That's a good kind of.
And so you were able to come back. You made that decision, transitioned the family out here. Tell me what it's been like, kind of the differences and the.
Yeah.
Like it out here, or do you? I know I love it. Come from at least the weather.
Yeah, right. Well, having been cooped up in my house now for 45 days or whatever it's been, with my 2 little kids in Pacific Heights, it does feel a little cramped. But no, I think we like it a lot. Look, it's very different. I think there's some things that are good, some things that are great, and there's some things that aren't as good. I think putting the personal life stuff aside for a second, I think that the differences in the market are perhaps more interesting to talk about. And we've had some London colleagues. We have a colleague from London who came over here now 18 months ago, and I was trying to explain it to him when we first came, and I was like, look, the issue isn't deals. There are bajillions of deals. The issue is prioritization.
Mm-hmm.
The issue is, where do you have a right to win? The issue is, how do you win, and where do you focus? And what's interesting is, like, today I've had 3 inbound, kind of things. Yesterday I had 4. It's just like you can run in a certain, like you can chase your tail forever. Yeah, exactly. It's like, oh, like, let's chase that squirrel. Let's chase this one. It's like you just go crazy.
Yeah.
And I think the thing that's kind of interesting about that is that, a banker will call up, and I don't mean to say anything negative. Bankers are not negative. It's just like, this is the way it plays out. It's banker calls up and says, oh, I've got this great, $100 million revenue software company, great margins, SaaS, good retention rates, blah, 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 blah.
Yeah.
What do you think? And what's going through our head a lot of times, and I'm sure every other private equity person feels this way, just to some extent. It's like, it's a great company, or how's this? At least as presented, undiligenced as presented, it looks like a great company.
Yeah.
But that could be very different from being a great opportunity for me.
Right.
Because every other person out there is going to think it's a great company, and all 50 of us who they send books to are going to be bidding against each other on it.
Mm-hmm.
And am I going to be the guy who advocates to my partners that we pay more than all those other folks do for a really nice asset that's being run in an auction that's being reported on the paper, and like we have strategics and all, and it's just, you're just like, even just look at the expected value of the time investment on some of that, and you're like, I have like a 1% chance of winning, a 2%, and you're just like, and I'm gonna have to spend how many hundreds of thousands, if not millions of dollars, to diligence this thing to provide a final right. And so that's not the issue in Europe. In Europe, there are few opportunities, and it's more about like lining them up years in advance, or talking to them proactively, or going to Copenhagen or wherever else to talk to them, meet them, and explain why they should think about U.S. money, or what they want to achieve in the United States, and how we can help them do that. And in the U.S. market, it's the opposite. There's like millions of things to look at. Its question is, how do we triage?
Yeah.
How do we decide how to take these thousands of things at the top of our funnel and figure out which ones to spend time on?
Do you feel like large funds like you've been forced to move down market like significantly to find some of the inefficiencies and stuff? Because it sounds like it's just being the bigger deals that match your profile are just so well shopped now, like you said.
Well, it's not that you can't buy a shop deal.
Yeah.
It's just more like very intellectually and honestly figuring out like why, like how are we advantaged?
Right.
Do we have a thesis that's contra contra the general view of it? Do we have a CEO ready to drop in who can change the way the business is operated? Do we have a portfolio company that we can merge with this? Do we have an acquisition idea that we have lined up someplace that no one else would have thought of? Right. Have we been, did we own a competitor to it previously? And might they value our expertise? So whatever it is, we really try very hard to like write down on paper, like not just sort of talk past each other on it, like, or be like, oh yeah, like we've got an angle, like actually try to figure out where we think we do have angles, or where we can be advantaged. And try to, really spend time on the ones that we think we can actually get done. Because look, the reality, the other thing is on some of these situations, if you're not first, you're last. And so there's like the absolute worst thing is coming in second, right? Like, I just
spend all the money.
I blew 3 months of time. I spent $1 million, and I don't even get a silver medal.
You don't even get the asset.
Right.
Yeah.
Right.
Yeah.
One time I got a bottle of wine in the mail from the founder of a company, because he was so like, he felt badly for us. It's only happened once. But that's a sort of market. So, and the other thing is like, a lot of times we just put aside all the inbound stuff, and we think more holistically, like let's think about outbound, like what assets do we want to try to own the next few years? And let's start planning now about, look, maybe they'll come up for sale in some sort of bank or auction. Maybe they won't. Maybe there'll be some catalyst for a deal before that. Maybe we'll have a coronavirus situation and they'll need to raise some money. Maybe they'll want to make an acquisition and the founders can't finance it themselves. Maybe we could bring them some acquisition ideas. Maybe. Well, let's think of some things and let's try to be proactive about what we do with them. Way ahead of there being
the event.
An event. Yeah. If you like, when the absolute worst is like we get a call, and it's like the first time we're hearing about the existence of the company is when it's for sale. It's like you already know you've lost.
Fair. That's fair. So yeah, there was actually a really interesting discussion on the site recently. It was distressed investing this time is different, and talking about all the dry powder that's out there, and how, all these distressed investors and all these firms are ready to pounce. And it's funny because we're kind of seeing it play out in the public markets where like there's so much money out there, and like, well, I think part of the reason the market's bound so fast is because there's nobody pulled out all the passive investing. Just let their money. Nobody pulled it out. There wasn't the full panic yet. Hopefully it won't happen. But
we'll see.
We'll see. Yeah. So tell me a little bit about your perspective on just the amount of capital in PE. And did you feel like, you said there's so many deals, is there enough? Do you guys have enough manpower, like, to actually do that legwork that you were talking about in terms of, for years or potentially a year or two, kind of prepping the deals before they even happen? Do you have that? Is that enough? Do you feel like
Yeah, it's tricky.
Because you look at the numbers, it's crazy. Like the amount of dry powder out there is just exploding.
Yeah.
Right. So
yeah, no, look, it's a balance, and I think it can be a tricky balance to manage. One is, managing people, managing highly intelligent, highly compensated private equity people isn't that easy, right? And I don't mean to say that like it's just like trying to make sure people are aimed at things that we're interested in, and trying to put enough wood behind the arrow, and also make sure that they've got enough to do, and have the right support structures. Because we want to go see some company in XYZ place because we've been tracking it or whatever. The associate probably shouldn't go alone. Like, we should figure out who, and then the question is like, well, why are we interested in it? Like, how long have we been tracking it? Like, what do we actually know versus don't know?
Right.
And you start kind of having those conversations. So it's not as easy as just like saying, hey, like, go figure out what you can find out on this company, let's go see it. Although sometimes it is that simple. But I'd say, so we're trying to figure out what the right balance of number of people that we can actually kind of deploy and manage appropriately in some sort of systematic fashion.
Yeah.
With also, maintaining some intimacy and some coverage. And I'd say one thing that you can get into trap in, I think, it's like, look, private equity is not a market share business. It's not like, you don't have like, just because someone, and like, you can like wait for your pitch, like to quote Warren Buffett or whatever, like you don't have to do anything ever. And just because someone else is successful and you miss something doesn't mean like you didn't like lose. Like you're just doing something different. So
it's just a question of like, there's committed capital and there's a certain time frame on it. And if you don't put it all to work, you don't put it all to work, and it's your right.
Yeah. Or sometimes you find things, at a pace that's too fast, and you say, hey, okay, like, we've just put out a bunch of money. Like, the bar is now a little higher.
Yeah.
For the rest of the year because we've just done a bunch of things. Or sometimes like, hey, the bar is a little lower, and we're trying to, we're not macro economists. We're trying to put out a similar amount of money, a similar number of deals each year, and also sell a similar number of companies and return a similar amount of money each year to the extent we can. And that can get tricky, in cycles, but it's really not about, keeping up with the Joneses. It's really more about like, hey, we're doing what we're doing, and maybe it'll work, maybe it won't. But
have you found there's been like some success in selling to not just less to strategics and more to other funds? Has that
we've done some of that. We've done some of that for sure. I think everyone has. Cultivating the strategics and actually getting a strategic to bite is, it's very hard to predict. The timing can be wrong. Their ability to pay, their interest in paying, what the pull push, what their worries or fears or analysts are saying about their motivations of their stock or whatever. So it's very hard to kind of figure out, like, sometimes, there's some big mergers in some industry, and then there's no, a mega merger happens, and then there's like no smaller M&A for a year or something, and you don't know when those exactly. It's hard to predict when those air pockets will be or whatever. So I think we don't try to really, we'd love to having strategic exits. That's great, but I think the sponsor exits can be great too, especially when we want to roll over, keep going at it, and maybe sometimes we can keep control of a business and sell a smaller stake, so we can get some money off the table that way. but continue to control the investment. Or in other places, we want to give up control and we want to just ride along with a 25, 35, 40% share,
Right.
and let someone else take the reins, who we like and trust and whatnot. And so
You feel like the flexibility, like there's enough flexibility with the structure of the fund to allow you guys to do that? Do you feel like because I know at least when I was in PE, it was like, the expectation is typically like 3 to 7 years, right, on the exit, and I think the fund life's around 10. Typically in a 10-year period, we see a lot of, at least one big pull down, like we're seeing it now, but it was a long bull run, right? And if the way I saw it is like valuations were stretched for like the last 5 years. Like I was hearing at least back in 2016, like, oh, we're way too high. We're way too high. Wait, it's gonna pull. And like if you had waited, it was hard.
I thought valuations were too high every year since 2011.
2011. So you're with me, okay?
So I'm with you.
Yeah.
And so it always feels like, oh, it's just a little out of reach.
I always feel like it's really hard because as from the financial discipline perspective, and like from a pure finance perspective, especially coming from that background, and not having like, you're not coming from like the VC background where you're like, well, let's just look at TAM and let's look at how monstrous this could be in 20 years. It's tougher, right?
For sure. I think you're exactly right on that stuff. I mean, look, again, we don't try to, we're not macroeconomists. If we just try to put out a similar amount of money, do a similar amount of deals, buying and selling, then, the stuff you're talking about, will work itself out. Now, I think one of the issues is that when you have an event like this, like what's happening now, or like what happened in 08, 09, there's not that much for sale. It's hard to actually deploy money. Like, okay, like, oh, the market's down, let's buy stuff.
Right.
What?
Yeah. Who's gonna sell you their distressed bit? It's
right, unless they're like really distressed. Okay. Not like, at least majority stake deals aren't like buying the whole company kind of deals aren't really getting, like, the whole market's shut down right now for that kind of stuff. Then you go look at, like, there's a bunch of pipes being done, but they're being done now to your point before, there's so much money out there. They're being done at very attractive rates for the companies. Right. You look at some of look at what Twitter got done, just happened right before the corona really hit. But like, it's like, it's like 0.375% interest. So less than 0.5% interest. And then a conversion premium that was 30% higher than the stock price at the time. Now the stock's down. So it's like almost like 100% premium now. But like, you look at that and you're like, that's pretty cheap. I look and I think Twitter will grow and it'll grow out of it. And over a 5-year period, like that might be a great investment. But you look at it from the company's perspective and it's like a pretty good financing, right? Or you
did a great job there. Yeah.
Sorry. Well, right. So yes, there are certainly some distressed things right now, but then there's also like, a whole bunch of folks piling in to try to do them, because there is a lot of dry powder, to your point. I think what's more interesting is just like when the market actually starts stabilizing, and the private market, there is like an M&A market again, like the debt markets are back, maybe at a lower level, maybe less attractive terms, but there's a functioning market, and there are actually people who want to sell into that. Right now, no one on the sell side is interested in actually selling into the storm right now. And even if they did, like, there's no debt market to support it. So I guess
there'll be some pent up demand later half of this year if we get back to somewhat normal. Like there'll maybe a flurry of
I think so.
activity.
I think it's possible. I think it certainly is possible. I mean, look, one of the issues of private equity that we deal with a lot is that, like, look, we can't own our companies forever.
Yeah.
We just can't. And portfolio proliferation is a huge issue, like a way bigger issue than anyone's ever talks about.
It's interesting.
It's just like, I'm on, it's like, hey, if I had 12 companies instead of 7 or whatever, I would never be able to do anything. Like, I wake up in the morning and you get like 100 emails because there's stuff going on at all these places all the time. And so, the ability to act, like, even if it's not perfectly economic, or even if you think in 6 months or 12 months or 2 years, you can do better.
Yeah.
Unfortunately, if you think like that, you'll never sell anything.
Yeah.
And so you kind of need to just pony up and sell stuff sometimes, even if it's not perfect.
That's an interesting concept in terms of like the number. That's interesting in terms of like the partner at a partner level, like yourself. Is that typically around where you'd like to be, in the 5 to 10 range, rather not getting up to the 12 to 15? Like if you get up to there, there's a problem because it's just hard to for your time.
For sure.
Yeah.
And actually even some of mine, we've tried to find ways to, bring some other people around it, maybe a principal or some other folks to make it lower touch. And look, some investments are low touch by their nature because you're a minority investor or
Right.
someone else is driving the truck and you're just, on it.
Mm-hmm.
But, the ones that are high touch where you're kind of driving, it can be very, very involved for sure. So yeah, like, I think that's right. I think the ones that you're, where you're kind of leading the charge as the majority owner and you're the partner kind of leading it, I think no more than 5 or 6, really.
Yeah. Or it gets pretty stressful.
It's stressful, but it's also just time. Like it's like, oh, there's a new opportunity in Atlanta. Like, oh, I guess I
gotta fly.
Can't do that because I'm going to Seattle to deal with my portfolio company thing. So
yeah, interesting. Well, Peter, I really appreciate all this. Is there any kind of advice you'd give your younger self? Or I guess before we even go there,
a lot, but go ahead.
Yeah, before we go there and wrap it up, just in the coming years through this I know it's hard to predict the future, but for private equity in particular and what you see coming through the rest of this year and next year, do you think that how are things like going to come out? Like when you said the debt market's coming out, you think there's just going to be a lot less leverage, obviously. Tighter covenants, like kind of how we came out of like the 2008, 2009, or do you feel like it's going to potentially go back to kind of high levels of leverage and aggressive valuations?
I think it will snap back pretty fast. However, I think it'll be a little bit of a haves and have-nots kind of thing. Mm-hmm. So for quality, for companies that maybe weren't like they're, most of the companies are affected in some way, but some companies are less affected than others, or for some it's a positive. What's happening with Corona and the situation. So I think for companies that are stable to growing and are considered quality, they will be able to go right back to kind of the leverage levels and other things that we've been talking about. I think for businesses that are face headwinds associated with the dislocation of coronavirus, I think it could be tricky. And I think a lot of those companies that have debt, that debt is traded way off, mm-hmm. Whether it's public or private. And so I think if you own one of those businesses, like selling it and, a buyer not being able to get the same debt package that the company already has can cause a misalignment as well. So it's going to take some time to kind of work through, but I think for the quality credits, it'll come back very quickly and and I think there's liquidity, unlike 08, 09, liquidity isn't the issue. Like the bank liquidity and lender liquidity is not the issue here.
The banks are really healthy, at least in the U.S.
Yeah, and look, and even if they're not healthy, they can go to the Fed window and kind of get money
free money
forever against a whole sorts of different assets. And so that's not the issue. The issue is the actual company performance.
Yeah. Fair. All right. So now we'll jump to the advice you'd give your younger self or any of the younger listeners that are kind of wanting to follow in your footsteps. What would you say?
Well, what I would say is, I'd say that there are a lot of different flavors of venture capital and private equity. And there really aren't, I really believe this, there aren't better flavors and worse flavors. They're just different. Mm-hmm. And so, for some people, they want to go work at the biggest buyout shop there is, and some other people want to go work at the best VC. Well, there's a history on these things. Like the best VC today is probably not going to be the best VC in 5 years or in 10 years, right? I mean, like these things change, and the biggest buyout shop has changed names, a bunch of times. And it's really more about, I think, finding a place or finding articulating to yourself and then being able to articulate in an interview why you want to do a certain flavor of private equity. I want to do information technology focused middle market private equity because I think this, and this. Mm-hmm. And obviously I know, look, I get the game. A lot of people just want a job in private equity and whatnot. Well, I think part of getting a job in private equity is actually credibly being able to say, look, I want to work at fill in the blank place or among these firms that look like this because I'm excited about this, and I think you guys are going to do really well the next 10 years because I see this mega trend, or I see convergence, or I see something.
Yeah.
And I think being able to like articulate that and forget what everyone's doing, forget what's hot right now. Just be like, I know all these people who were doing these things, or going to funds that maybe were out of favor or new, or no one understood what they were doing. And, whatever's doing well right now is almost certainly going to need to evolve to do well in the future. And so I think the other thing about it is just the evolution of the industry is constant. And so, and I do mean constant, like if you're in private equity and you're not constantly thinking about challenging the way you do things, challenging how you spend your time, challenging how you're prosecuting opportunities, what your processes are, how you're adding value, then eventually it'll stop working. And so so as younger people like thinking about the industry, I think it's more like, hey, look, sector specific stuff has I think been proven to be not a bad place to be. Whereas I think when I was coming up, people were like, you want to work in a sector fund? Like, that's so limiting. And you sure you want to do,
pigeonhole you and all that?
Yeah, all that stuff. And it's like, well, I do, but at the same time, like you go work at a healthcare fund, and yeah, you're only doing healthcare. That's right. But like you gotta have to make your peace with that. But at the same time, like maybe that healthcare fund, because all they do is healthcare,
has an edge.
It's gonna do a pretty good job in healthcare, right? Yeah. So and maybe if you join it when it only has 15 people or 20 people or 50 people, and you think there's road for it to become a 100-person firm and manage billions of dollars, well, maybe that's a pretty good opportunity for you.
Yeah, I think that's great. I think it's awesome advice. Don't always chase the shiny object in the biggest name is kind of how we can summarize that.
For sure.
Yeah,
for sure. Absolutely. When you have I think some of the firms, some of the biggest firms have proven they can keep doubling, or they can keep getting bigger, and maybe they're great places, but others haven't. And so it's more, all I can, just like, what's the famous quote that JP Morgan said about stocks? Someone asked him to comment on stocks, and he's like, what do you think stocks will do? And he said, they will fluctuate, or something like that. And yeah. It's the same thing. It's more just like, where do you want to, vote with your feet?
Got it. Well, Peter, thanks so much for taking the time. It's been really insightful and fun, and good catching up as well.
Absolutely, Pat. Anytime. Thanks so much. Good luck with everything.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, Patrick@wallstreetoasis.com. Until next time.